China's economic growth over the past few decades has been nothing short of remarkable, transforming it from an agrarian society into the world's second-largest economy. Beginning with the reforms initiated in the late 1970s under Deng Xiaoping, China embraced a blend of socialist planning and market-oriented reforms that unlocked unprecedented growth. These reforms, commonly referred to as reform and opening up, allowed for the decentralization of economic decision-making, the encouragement of private enterprise, and the opening of China to foreign trade and investment. As a result, China's GDP has grown at an average rate of nearly 10% annually for several decades, pulling hundreds of millions of people out of poverty and establishing China as a global manufacturing powerhouse. Key sectors such as manufacturing, technology, and services have driven this expansion, helping China shift from being a producer of low-cost goods to a more diversified economy that now leads in high-tech industries such as electronics, AI, and green technology. China's role in the global economy has grown just as rapidly, making it a pivotal player in global trade, investment, and finance. As the world's largest exporter and a major importer, China has integrated deeply into global supply chains, playing a crucial role in producing everything from consumer electronics to medical equipment. Its Belt and Road Initiative, BRI, is an ambitious effort to extend China's economic influence through infrastructure investments across Asia, Europe, and Africa, enhancing its economic ties with developing countries while creating new markets for Chinese goods and services. Additionally, China's massive foreign exchange reserves and its influence in global financial institutions, such as the World Bank and the International Monetary Fund, IMF, have further cemented its significance. As China continues to expand its global economic reach, it has become a key driver of global economic growth and a central figure in shaping the future of the world economy. China's economic history spans thousands of years, with its imperial era marked by periods of both prosperity and stagnation. During ancient times, China was an economic powerhouse, particularly during the Tang and Song dynasties, known for their advancements in agriculture, trade, and technology. The Silk Road, for example, played a vital role in facilitating trade between China and the Western world, allowing for the exchange of goods such as silk, spices, and tea. However, China's isolationist policies during the Ming and Qing dynasties, particularly in the late imperial period, hindered its economic progress. The country fell behind the industrial revolutions taking place in Europe, leading to a decline in its global economic position. By the late 19th and early 20th centuries, China's economy had weakened significantly due to internal strife, foreign invasions, and the collapse of the Qing dynasty, which left the country impoverished and fragmented. The establishment of the People's Republic of China in 1949 under Mao Zedong marked a turning point in China's economic development. The new communist government sought to transform China into a self-sufficient, socialist economy through the nationalization of industry and land, as well as centralized planning. This era saw massive agricultural and industrial campaigns, most notably the Great Leap Forward, which aimed to rapidly industrialize the country and collectivize agriculture. However, these policies often led to inefficiencies, resource mismanagement, and, in the case of the Great Leap Forward, catastrophic famine. By the mid-20th century, China remained largely agrarian and underdeveloped, with a state-controlled economy that struggled to keep pace with global economic advancements. Despite attempts to modernize, China's economy under Mao was marked by limited productivity and an inability to integrate into the global market. China's transition from a planned to a market-oriented economy began in earnest after Mao's death in 1976, under the leadership of Deng Xiaoping. Recognizing the limitations of the centrally planned model, Deng introduced a series of economic reforms that gradually shifted the country toward a more open, market-driven economy. These reforms allowed for greater private enterprise, foreign investment, and the decentralization of decision-making in rural areas, starting with the household responsibility system, which gave farmers more control over their land and production. Special economic zones were established in coastal areas to attract foreign capital, with Shenzhen becoming a symbol of China's rapid industrialization. Over time, these reforms led to the dismantling of the old command economy, as state-owned enterprises were restructured and market mechanisms were introduced. This transition allowed China to embrace globalization, leading to its eventual rise as one of the most significant players in the global economy, while still maintaining an overarching framework of state control over key industries. Agriculture has historically been the foundation of China's economy, supporting its large population for millennia. In ancient times, Chinese agricultural techniques, such as rice cultivation and irrigation systems, were highly advanced and played a significant role in sustaining the empire's population and economic stability. However, agricultural practices remained labor-intensive and traditional well into the 20th century, contributing to inefficiencies in production and food security issues. The collectivization of farms during the Mao era, particularly through the establishment of communes, was intended to increase productivity, but often led to disastrous results, including widespread famine. With the introduction of economic reforms in the late 1970s, agriculture in China began to modernize. The household responsibility system replaced collective farming, allowing individual households to lease land and take responsibility for their own agricultural output. This significantly boosted agricultural productivity and improved rural incomes. In recent decades, the Chinese government has continued to prioritize agricultural modernization through the adoption of technology, increased mechanization, and the promotion of sustainable farming practices to ensure food security for its 1.4 billion people. Manufacturing and industry have been at the heart of China's rapid economic expansion, earning the country the title of the world's factory. Beginning in the 1980s, China's shift from an agrarian economy to an industrial powerhouse was driven by economic reforms that welcomed foreign investment, technological transfers, and export-oriented growth. Special economic zones, SEZs, particularly in coastal areas such as Shenzhen, became hubs for manufacturing, attracting multinational companies seeking lower labor costs and efficient supply chains. China's competitive advantage in manufacturing was initially based on its vast labor force and low wages, which made it the preferred destination for the production of consumer goods, electronics, textiles, and machinery. Over time, however, China has moved up the value chain by investing in technology and infrastructure, allowing it to compete in more advanced sectors such as automotive, aerospace, and high-tech manufacturing. Today, China not only assembles products for global brands, but also designs and manufactures sophisticated technologies, including smartphones, robotics, and renewable energy equipment, solidifying its position as a leader in global manufacturing. The rise of China's service sector marks the next phase of its economic development, reflecting the country's ongoing transition from an industrial economy to a more diversified and consumer-driven model. Historically, the service sector played a smaller role in the economy compared to agriculture and manufacturing, but its growth has accelerated in recent years, driven by increased domestic consumption and the expansion of financial services, technology, and e-commerce. The financial sector, in particular, has become a key component of China's economy, with the development of modern banking systems, capital markets, and insurance industries. The rise of major financial hubs, such as Shanghai and Shenzhen, has attracted both domestic and international investments. Moreover, China's technology sector has experienced explosive growth, with companies like Alibaba, Tencent, and Huawei leading the charge in areas such as e-commerce, digital payments, artificial intelligence, and telecommunications. The digital economy, which includes sectors like online retail, mobile payments, and fintech, has become a major contributor to China's GDP, supported by widespread internet usage and innovation in mobile technology. China's transition from a manufacturing-based economy to a more service-oriented model is also evident in the rapid growth of its tourism, entertainment, and healthcare industries. The country has seen a surge in domestic tourism, fueled by rising incomes and an expanding middle class, which has led to increased investment in infrastructure, hotels, and attractions. Similarly, China's entertainment industry, particularly in film, music, and gaming, has grown significantly, with Chinese films and online games gaining popularity both domestically and internationally. Healthcare, another crucial sector, is undergoing transformation as China faces the challenge of providing services for an aging population. The government has been investing heavily in healthcare infrastructure and services, seeking to modernize the system and increase access to high-quality care for its citizens. These service industries are playing an increasingly important role in creating jobs, boosting domestic consumption, and driving overall economic growth. China's reform and opening up policy, launched in 1978 by Deng Xiaoping, marked a turning point in the country's economic strategy, transitioning it from a largely closed and centrally planned economy to one that increasingly embraced market mechanisms and global integration. Prior to this period, China's economy was heavily controlled by the state, with strict central planning that dictated production and investment. However, these policies led to inefficiencies, and the country remained underdeveloped. Deng's reforms introduced several key changes, such as allowing private ownership in agriculture through the household responsibility system and encouraging the establishment of private enterprises in certain sectors. Special economic zones were created in coastal areas, offering incentives for foreign investment and fostering an export-driven growth model. These policies were revolutionary for China, as they not only improved productivity and increased incomes, particularly in rural areas, but also set the stage for China's rapid industrialization and integration into the global economy. Over time, the reform agenda expanded, allowing more freedom for market forces while maintaining significant government oversight. Despite the market reforms, state-owned enterprises, or SOEs, have continued to play a crucial role in China's economy, reflecting the country's unique model of socialism with Chinese characteristics. SOEs dominate key sectors such as energy, telecommunications, steel, and banking, and they are seen as instruments of national development, tasked with implementing government priorities such as infrastructure development and poverty alleviation. During the early stages of reform, many SOEs were inefficient, burdened by overstaffing and outdated technology. In the 1990s, China embarked on a massive restructuring of SOEs, leading to the privatization of many smaller enterprises and the consolidation of larger ones into more competitive and efficient entities. Today, China's largest SOEs, many of which are among the biggest companies in the world, are more productive and profitable, playing a key role in the country's economic ambitions, including the Belt and Road Initiative and China's push toward technological self-reliance. However, the dual presence of SOEs and private firms in the same market has led to ongoing debates about market fairness and the true extent of competition in China's economy. Government regulation and market liberalization have been carefully balanced in China's economic model, as the country's leadership has sought to manage the complex transition to a more open market economy while maintaining control over key sectors. The Chinese government has historically maintained a significant role in regulating economic activity, with state planning bodies like the National Development and Reform Commission, NDRC, setting guidelines for investment, industrial policy, and infrastructure development. However, as the economy has grown and diversified, there has been a gradual move toward market liberalization in areas such as finance, trade, and labor. The government has encouraged foreign direct investment, FDI, in strategic industries while also protecting certain sectors from foreign competition to nurture domestic firms. More recently, China has implemented reforms aimed at improving the efficiency of its financial markets, such as opening its stock markets to foreign investors through initiatives like the Shanghai-Hong Kong Stock Connect. These regulatory changes reflect China's ambition to position itself as a global economic leader, while still retaining a firm grip on the strategic direction of its economy through state planning and governance mechanisms. The Belt and Road Initiative is one of China's most ambitious and far-reaching international economic policies, aimed at expanding its influence and economic ties across Asia, Europe, and Africa. Launched in 2013 by President Xi Jinping, the BRI seeks to improve trade and infrastructure connections between China and over 140 participating countries through massive investments in roads, railways, ports, and other key infrastructures. The initiative is often described as a modern-day Silk Road, reflecting China's historical trade routes, but on a much larger scale. The BRI has helped China gain access to new markets for its goods and services, secure critical natural resources, and strengthen political and economic partnerships in developing regions. In addition to physical infrastructure, the BRI also encompasses digital and energy projects, positioning China as a major investor in cutting-edge technologies and renewable energy in partner countries. While the initiative has been praised for providing much-needed infrastructure to developing nations, it has also faced criticism, with some observers raising concerns over debt sustainability for recipient countries and the geopolitical implications of China's expanding global footprint. China's role in global supply chains is pivotal, given its position as the world's largest exporter and one of the most important hubs for manufacturing and assembly. Over the past few decades, China has become deeply integrated into global supply chains across various industries, from electronics and automotive to textiles and machinery. Many multinational companies rely on China not only for its low-cost labor, but also for its highly developed infrastructure, efficient logistics, and well-established production ecosystems. In particular, China has emerged as a leader in the production of high-tech goods, such as smartphones, semiconductors, and solar panels, making it a critical player in the global technology supply chain. The COVID-19 pandemic highlighted both the importance and vulnerabilities of China's role in global supply chains, as disruptions in Chinese factories had ripple effects across the world. In response to these challenges, China has made efforts to further solidify its position by investing in advanced manufacturing and increasing its capacity in areas such as artificial intelligence, robotics, and green technologies. This shift reflects China's strategy to move up the value chain and reduce its reliance on lower-end manufacturing. China's major trade partners include a diverse group of countries, spanning developed and developing economies alike. The United States, the European Union, Japan, South Korea, and the ASEAN countries are among China's largest trading partners, reflecting its extensive trade networks across both Western and Asian markets. China has a significant trade surplus with many of these countries, particularly the U.S., which has led to trade tensions, most notably during the U.S.-China trade war that began in 2018. The imposition of tariffs by both sides created uncertainties in the global trade environment, though the two countries remain major trading partners. Meanwhile, China has sought to strengthen its economic ties with other regions, particularly through the signing of trade agreements, such as the Regional Comprehensive Economic Partnership, which includes many Asia-Pacific nations. China's trade balance has generally been positive, with exports exceeding imports, particularly in sectors like electronics, machinery, and textiles. However, China also imports significant quantities of raw materials, energy, and agricultural products, reflecting its need to sustain its industrial base and meet the demands of its growing middle class. Managing trade relationships and addressing trade imbalances will continue to be a priority for China as it navigates the complex dynamics of global trade. China's banking sector is a central pillar of its financial system, playing a critical role in the country's economic development and monetary policy implementation. The Chinese banking system is dominated by large state-owned banks, such as the Industrial and Commercial Bank of China, ICBC, China Construction Bank, CCB, and Agricultural Bank of China, ABC, which are among the largest financial institutions globally. These banks are responsible for extending credit to key sectors of the economy, particularly in areas aligned with government priorities, such as infrastructure development, real estate, and state-owned enterprises, SOEs. The People's Bank of China, PBOC, the country's central bank, is tasked with overseeing monetary policy, maintaining financial stability, and regulating the money supply. Unlike many Western central banks, which operate under a more independent mandate, the PBOC works closely with the Chinese government to implement policies that promote economic growth while managing inflation and controlling systemic risk. In recent years, China has also developed a more flexible monetary policy approach, using tools like interest rate adjustments and reserve requirement ratios to address economic fluctuations and maintain stable growth. China's stock exchanges, primarily the Shanghai Stock Exchange, SSE, and the Shenzhen Stock Exchange, SSE, have become important hubs for capital markets in Asia and are increasingly open to global investors. Historically, China's stock markets were limited in scope, with trading largely restricted to domestic investors and state-owned enterprises, SOEs, dominating the listed companies. However, market reforms in recent years have expanded the range of investment opportunities, allowing more private companies to list and increasing access for foreign investors. Programs such as the Shanghai-Hong Kong Stock Connect and Shenzhen-Hong Kong Stock Connect have enabled foreign investors to trade Chinese stocks directly, broadening the appeal of Chinese markets on the global stage. Moreover, the development of China's domestic bond market and the growth of asset management firms have also opened up new avenues for investment. Despite these advancements, China's capital markets are still maturing, and challenges such as market volatility, regulatory changes, and concerns over corporate governance persist. Nevertheless, the increasing participation of foreign investors and the growing influence of China's financial markets are positioning the country as a significant player in global finance. The rise of technology has had a profound impact on China's financial services sector, particularly through the rapid expansion of financial technology, fintech companies. China is now home to some of the world's most advanced and widely used digital payment systems, with platforms like Alipay, run by Alibaba's Ant Financial, and WeChat Pay, owned by Tencent, dominating the market. These mobile payment systems have revolutionized the way Chinese consumers conduct transactions, leading to a dramatic shift away from cash and traditional banking methods. Fintech innovation in China extends beyond payments. It includes online lending, wealth management, and insurance services. The country has also become a leader in the development of blockchain technologies and digital currencies, with the People's Bank of China piloting its own central bank digital currency, CBDC, the digital yuan. This move positions China at the forefront of the global digital currency race. However, the rapid growth of fintech has also raised concerns about financial stability, leading the Chinese government to impose stricter regulations on major fintech firms, particularly regarding consumer protection, data privacy, and lending practices. Despite these regulatory challenges, fintech remains a key driver of innovation in China's financial system, offering significant opportunities for growth and financial inclusion. China faces significant demographic challenges, particularly the issue of an aging population, which threatens to slow its economic growth and strain its social welfare system. After decades of rapid population growth, largely driven by its rural workforce moving to cities for industrial jobs, China now faces a declining birth rate and a rapidly aging society. The one-child policy, which was in place from 1980 to 2016, drastically reduced birth rates, leading to an imbalance in the working-age population. As a result, China's population is aging at a faster rate than many other countries, with projections showing that by 2050, a third of its population will be over 60 years old. This demographic shift poses a challenge to the country's labor market, as fewer workers are available to support a growing elderly population, potentially slowing productivity and economic output. In response, the Chinese government has implemented policies to encourage higher birth rates, such as relaxing family planning laws and offering incentives for families to have more children, but the effects of these changes remain uncertain. Additionally, China is exploring ways to increase labor productivity through technology and automation to mitigate the effects of an aging workforce. Income inequality and urban-rural disparities are also significant challenges for the Chinese economy. While economic reforms and rapid industrialization have lifted hundreds of millions out of poverty, the benefits of growth have not been evenly distributed. Urban areas, particularly along China's eastern coast, have experienced tremendous prosperity, with high levels of infrastructure development, education, and healthcare access. Meanwhile, rural regions, especially in the interior provinces, have lagged behind in terms of economic development and living standards. Migrant workers from rural areas often face significant barriers to integrating into urban economies due to the hukou system, which restricts access to public services, such as education and healthcare based on one's household registration status. The income gap between urban and rural residents has contributed to social tensions and could hinder China's efforts to create a more equitable society. To address this issue, the Chinese government has launched initiatives aimed at reducing poverty in rural areas, including investments in rural infrastructure, agricultural modernization, and social welfare programs. However, closing the income gap remains a complex and ongoing challenge. Environmental issues and sustainability efforts present another significant hurdle for China as it balances economic growth with environmental protection. Decades of rapid industrialization have come at a high environmental cost, with widespread pollution of air, water, and soil, as well as significant carbon emissions. China is the world's largest emitter of greenhouse gases, and its cities frequently experience severe air pollution, leading to public health concerns and international criticism. The government has recognized the need to transition to a more sustainable growth model and has made significant investments in green technology, including renewable energy sources such as solar and wind power, electric vehicles, and energy efficiency improvements. China has set ambitious goals to peak carbon emissions by 2030 and achieve carbon neutrality by 2060. However, the transition to a greener economy is complicated by the country's reliance on coal and other fossil fuels, which still account for a large portion of its energy consumption. While China leads the world in renewable energy capacity, it must balance its short-term economic needs with long-term sustainability goals, a challenge that will shape the future of its economy and its global environmental responsibilities. China's global economic influence has grown exponentially over the past few decades, particularly through its active participation in major international organizations such as the World Trade Organization, WTO, the International Monetary Fund, IMF, and the Group of 20, G20. Since joining the WTO in 2001, China has been a key player in shaping global trade rules and practices. Its entry into the WTO facilitated a surge in its exports and foreign direct investment, solidifying its role as a global manufacturing hub. Additionally, China has increasingly taken on a leadership role within the G20, using the platform to promote its vision for global economic governance, particularly in areas such as infrastructure development and financial inclusion. China's contributions to the IMF, including providing financial assistance to struggling economies, have also demonstrated its growing influence in international financial systems. By being actively involved in these global organizations, China is not only participating in but also reshaping the norms and structures of global economic governance, reflecting its aspirations to be recognized as a global leader. Foreign investment has been another key avenue through which China has expanded its economic footprint worldwide. Chinese companies, particularly state-owned enterprises, have been aggressively pursuing foreign investments and mergers and acquisitions. M&A across various sectors, including energy, technology, real estate, and manufacturing. The Belt and Road Initiative, BRI, serves as a cornerstone of this strategy, with China funding infrastructure projects across Asia, Africa, and Europe to improve trade routes and secure access to resources. Chinese investments have not only strengthened its economic ties with other countries, but have also provided a significant boost to developing economies by improving infrastructure and creating jobs. However, China's M&A activities, particularly in strategic industries like technology, have at times faced resistance from Western countries due to concerns over national security and intellectual property. Despite these challenges, China's outward investment strategy continues to be a critical component of its effort to diversify its economic interests and establish a broader global presence. China's economic relations with both developed and developing nations have evolved significantly, reflecting its status as a major global economic player. With developed countries, China has fostered deep trade ties, particularly with the United States, the European Union, and Japan, although these relationships have sometimes been strained by issues such as trade imbalances, intellectual property disputes, and geopolitical tensions. The U.S.-China trade war, for example, underscored the complexities of economic relations between the world's two largest economies, with tariffs and protectionist measures affecting global supply chains. Nonetheless, China remains a vital trade partner for many developed nations, and the interdependence of these economies is undeniable. At the same time, China has strengthened its relations with developing nations, particularly through its Belt and Road Initiative, offering loans, investments, and infrastructure projects to countries across Africa, Latin America, and Southeast Asia. These efforts have allowed China to secure important economic partnerships and political alliances while gaining access to critical resources and new markets. China's dual focus on both developed and developing countries highlights its strategic approach to cementing its influence in the global economy. The future of China's economy is heavily tied to its digital economy and technological innovation, areas in which the country has made tremendous strides. China has rapidly become a global leader in fields such as artificial intelligence, AI, 5G telecommunications, robotics, and e-commerce. Companies like Alibaba, Tencent, and Huawei are at the forefront of these industries, driving innovation and reshaping the digital landscape, not only within China, but globally. China's digital economy is characterized by its widespread adoption of mobile payments, online retail, and digital services, with platforms such as WeChat and Alipay integrating multiple services into single apps, offering unparalleled convenience to consumers. The government has prioritized technological self-reliance, investing heavily in research and development, R&D, to reduce dependency on foreign technologies, particularly in response to geopolitical tensions and trade restrictions from countries like the United States. Over the coming years, China's focus on technological innovation is expected to play a critical role in its economic development, with the digital economy becoming a major driver of growth. In addition to its push for technological innovation, China is also positioning itself as a leader in the green economy and renewable energy transition. Recognizing the environmental toll of decades of rapid industrialization, China has committed to achieving peak carbon emissions by 2030 and reaching carbon neutrality by 2060. These goals have prompted significant investment in renewable energy sources, including solar, wind, and hydropower, where China is already a global leader in both production and installation capacity. The country is also advancing in electric vehicle (EV) manufacturing, with companies like BYD and NIO emerging as major players in the global EV market. Furthermore, China's government has implemented policies to encourage energy efficiency, green buildings, and low-carbon technologies across various sectors. While challenges remain, such as the continued reliance on coal for energy generation, China's transition to a green economy is likely to play a key role in its future economic strategy, as the country aims to balance growth with sustainability and fulfill its international climate commitments. Looking ahead, predictions for China's economic growth and its role in the global economy are mixed, reflecting both opportunities and challenges. On one hand, China's sheer size, market potential, and technological advancements position it to continue as a major engine of global economic growth. The country is expected to remain a key player in global supply chains, trade, and investment, while its Belt and Road Initiative will further cement its economic influence in developing regions. On the other hand, China faces several headwinds, including an aging population, slowing productivity, rising labor costs, and geopolitical tensions, particularly with the United States and its allies. These challenges could affect China's ability to sustain the high levels of growth it has experienced in the past. Nonetheless, many economists believe that while China's growth may moderate, it will remain robust by global standards. As China continues to evolve and adapt to new economic realities, its global role is likely to expand, particularly as it seeks to shape international norms and institutions to reflect its growing influence on the world stage.